Anytime that we're about to start showing you some actual numbers, which are based on estimates and based on historical assumptions and assumptions going forward, guess what? None of this is guaranteed, and you should do your own due diligence. We're not financial advisors. We're not offering financial planning advice, all these things that you probably know already. So do your own due diligence, start here and continue that conversation and make sure that you're in a place where you've consulted those that you need to before actually putting money down on something, which is good advice wherever you go.
Agreed. So speaking of good advice, you also want to understand the fundamental asset class, right? So before we get into this financial engineering piece, by the way, before I forget, I'm going to start calling you the OG, the original Gregg.
There you go. I like it.
Okay, so this is a typical property that is in inventory right now. We wanted you to just like put eyes on this thing. We actually, believe it or not, about 35% of investors with JWB purchase from being on this show right now. So
amazing,
like,
right?
Yeah, which is really, really cool. So like this is normal to like check it out, look at the numbers and go to chatwithjwb.com. But GC, why don't you tell us what we're looking at here?
Yeah, for all of our veterans, our Not Your Average Investor community veterans, you've seen this for many, many, many weeks.
This is what we used to call the JWB rental property of
the week. So we do bring it back every once in a while, and I thought this would be an appropriate time. So as Pablo mentioned, this is an asset, and I think this helps kind of make this tangible when we get into the debt versus debt versus cash concepts. We could be talking about it on this specific asset, but at the end of the day, these are what we fill our clients' portfolios with: single family rental properties here in Jacksonville, Florida, focused in workforce housing neighborhoods. And these are some of the high level details that are very representative of the entire portfolio that we have. This is one asset. Of course, there's more, but you can see here your purchase prices. On this one, it's $228,000. Purchase prices range from about $180,000 to about $280,000 here in Jacksonville, Florida. So my friends in San Diego and other parts of the country where home prices are way higher. That wasn't a misstep there. Home prices obviously are lower here. The median home sales price in Jacksonville is about $350,000, $360,000. So you can see that's what workforce housing means. You're right below middle income. That's the sweet spot. That's where you want to be for maximizing your 5 profit centers of rental property investing.
Got it. So just kind of like for our friends that are listening to this thing on the podcast, because we publish this later on the podcast, purchase price of $228,000, monthly rent about $1,373. It's a 3-bedroom, 2-bathroom home, 1,230 square foot. That's rented already. Projected rent price appreciation year over year is about 3.6%. Projected home price appreciation, which is why people come to Jacksonville, because it is the best in class home price appreciation in cash flowing markets, is 4.8%, which ends up with an IRR for this one is 11.96, just a clip under 12%. But there's something special happening right now that also adds to that specific IRR, right? Do you see?
Yeah, 11.96 is higher than our typical returns are. And the reason is because of the incentives that we are offering right now that will likely be going away in the future. So we do offer an incentive here, which is our rate buy down incentive. And because interest rates have been higher, especially over the last couple of years, we have done everything we can to help our clients achieve a very low interest rate. And so even though interest rates have come down over a full percent just in the last couple of months, just on their own, we're still offering this incentive, and it equates to about a $5,500 savings for the client. And that's available for all properties that are put under contract at this time. But I can share with you, as interest rates continue to come down, which is what we're expecting, we're not going to offer that rate buy down incentive at some point in the future. So certainly something you want to take advantage of. And then the other discount that we do offer is what we call our bundles. Our bundles discount, right? So for any client that purchases 3 homes or more at a time, the discount is $5,000 on every home. So I had a personal friend who just acquired a portfolio of 7 properties that I helped him with, and 7 properties times 5,000. He was able to pocket $35,000 of cash flow because of that multi-purchase, that bundles discount. So that's available now as well.
There you go. So reason to go to chatwithjwb.com to take advantage of that incentive, right? Like you're selling a $1 million property in San Diego and you want to come over and pick up 3 of these homes or 5 of these homes because you can finance it. Then you also get $5,000 off per home plus these incentives. Go to chatwithjwb.com. Paul, I know that you own a handful of these and your dad owns a handful of these. What do you think of that purchase price over there? $228,000.
I mean, it's amazing, right? I grew up here in California, and $250,000 wouldn't even get you half of a garage, right? So it's always amazing to me whenever I see one individual property for anything less than $500,000 in my world. It's like, wait a minute, what part of the town? But I own a bunch of these. My dad owns a bunch of these. If you've been on previous shows, you know my dad's getting ready to retire. We're selling his dental practice. We're selling his house. We're actually helping him move out to Palm Springs. And he's able to do that specifically because a lot of these single family homes that he's bought and I have bought for him and gifted to him over the years. And yeah, I see these and they make me smile because when I see these, the mental and emotional reaction I have is like, oh gosh, my dad's able to retire off these. Oh gosh, I have time, freedom, and ownership of my own time because of these, because I have passive income coming off of a whole bunch of just these, which is amazing. I love it.
Love it. Love it. Love it. All right. So let's get into the meat of this instruction. So this is the numbers of an all cash purchase. For this example, we're using $240,000 for a purchase price. That means down payment plus closing costs. GC, all right, so I'm just going to kind of rattle off this number. Down payment plus closing costs of $236,700. Net rental income in year 1 is going to be $11,358. Net rental income in year 10 moves up to $13,188. Home price appreciation years 1 through 10, $108,497. Total profits in 10 years is $230,000, 408. That is a total IRR of 8.4% with an all cash purchase.
There you go.
Yeah. So my first question is, why in an all cash purchase is this like down payment plus closing costs, $236,000?
I thought you might ask that.
Yeah.
Well, that is the incentive that we're talking about at play. So for your cash purchases, one of the reasons that folks would gravitate to a cash purchase if they have the ability to do that is because your closing costs are a lot lower. And so your closing costs are estimated to be about $1,500.
Mm-hmm.
Well, when you have roughly a $5,500 incentive going your way, that in essence brings that your total investment down. Even though it's $240,000 purchase price, your out of pocket would actually be less if you take advantage while that incentive is still in place.
Got it. Paul, can you explain the type of person that buys all cash? This like 8.4% IRR. Is that still a good investment? Are people going away from that? What would be the reason to buy this thing all cash?
Yeah, I mean, very bluntly, if you're a Wall Street hedge fund manager or you manage millions and millions of dollars on Wall Street and you're able to produce an 8.4% clip, you're getting a huge bonus. You would get a massive bonus if you're on Wall Street creating an 8.4% return for your clients. Huge bonus, right? You'd be doing backflips, right? So absolutely. The investor who's looking for this, again, I think it comes down to investment objectives. If you're looking for an all cash purchase, you might have a shorter timeline, right? And you might have a situation where you're, a little bit more advanced in age, right? You have a 1 year, 2 year, 3 year timeline to really reap the maximum benefit from your investments, because leverage really shows its true colors and shows its massive advantages the more time you give it, right? And we'll get into that in a little bit with Gregg. So if you have a shorter timeline, you are insanely risk adverse, not insanely, but I'd say dramatically risk averse, maybe out of a scale of 1 to 10 on a risk scale, maybe you're a 1, right? Maybe you're a 2, right? Because anytime you do factor in debt, you are taking moderately risk. We could absolutely adjust for that risk 100%, but let's call a spade a spade. When you add the factor of debt in, there is a slight risk, maybe a point and a half. Maybe you're a 3 or a 4 on a risk scale. That's absolutely appropriate for you. But I know my father, took him a long time to get used to the concept of debt. And we started with some cash properties. He saw how it went. And then we were able to introduce debt once he felt he had the security in place of those all cash. And then we used the debt to really accelerate things and financial engineer, right? So that's why someone may be more comfortable to start with an all cash purchase, right? Shorter timeline and investment objectives that match up to that, right?
Makes a lot of sense. Anything to add to that?
No, I think you nailed it.
Yep, totally nailed it.